Want to talk about the earnings this quarter. Also want to talk about your outlook on where we really are in the economy. When you look at the firm, it looks like there was actually a net loss compared with a profit of last year in terms of the same quarter. And then in terms of the value of the portfolio, looks like it fell by about 6.7% on a relative basis, obviously, to the S&P and the wider market. Doing better. But where are we really?
Well, Andrew, it's great to be here. We actually had an outstanding quarter. When you look at our performance across the board, we beat public market indices. It was led by our hedge fund area. We also had great responses from our investors to our performance. We had $88 billion of inflows, which was the second most in our history. Really remarkable there, led by our real estate group, which raised more than $30 billion in the quarter for the largest private equity or real estate private equity fund ever raised. And today we've got $170 billion to deploy in a very dislocated environment. So we feel very good about our performance, and we recognize we're obviously in a challenging environment. I would just say for our shareholders, it was our second highest quarter for distributable earnings, as you noted. So we're very pleased.
So speak to this, though, and there is this big Wall Street Journal article that actually describes how much money you've raised in terms of that real estate fund. When you start to think about how to deploy this money in what you called a dislocated market, what are you thinking about?
Well, what we're thinking about today is an economy that is obviously going through a transition. It today has a fair amount of strength, but it's decelerating. So we're seeing some slowdowns on the ground in shipping volumes in our ports. We're seeing it in online advertising. We're seeing it in furniture. We're seeing a range of areas where there's a deceleration, but we're also at the same time seeing a lot of economic strength. Our private equity portfolio had 17% growth in revenue in the quarter. We also have seen strength in particular in leisure and travel. So it's a mixed picture, but we're expecting further deceleration as a result of the Fed actions. And that's because we're seeing inflation out there. It's moderated given commodities and shipping costs, but still labor markets are very tight. We're also seeing rental housing very strong. I would say rental rates and apartments are growing 3 times the shelter number that's reported by the government today. So our expectation is the economy will continue to slow, but it is today stronger than most people realize. And I'd also say inflation is higher than most people sort of expect. They're expecting it to come down. We think it'll be stickier. So it's like a train that's got a lot of momentum. Right. The Fed's pulling on the brakes.
When you say inflation is going to be stickier, we were just hearing Elon Musk on his call last night. He thought that inflation was going to start to modulate by the end of this year. When you guys talk on your famous Monday morning meeting, how sticky do you think it is, and how long do you think it's prolonged for?
You know, I think it varies. Some of the areas obviously are turning over, and there is going to be some excess capacity. But as I noted, in labor markets, in housing markets, you know, there are shortages. Energy markets also. So I think there's some element of this that'll burn off. Some of the highest numbers will start to come down, but then we'll hit a level that I think is above the Fed's target, and it'll take a while, which means I think the Fed at some point here will raise rates to a level and they'll stay. The market's anticipating the Fed to cut rates pretty quickly, but I think the inflation sticks with us a little longer, and that obviously has a big impact on how you think about investing.
Shepard Smith here. Thanks for watching CNBC on YouTube.